All right, guys, we've got like 2 weeks left in the year, and so far the NASDAQ is less than 1% off of all-time highs. We've got Bitcoin that's bouncing as of the rate decision, which there was no change today. Rates are dumping on the bond markets, and yeah, I guess there's a lot to talk about. Bitcoin's getting a big bounce. There was a shakeout, a big liquidation event a couple days ago. But guys, tell me what is happening out there. What is the big macro picture? And then we'll jump into the charts.
The shorts are in shambles.
Beat me to it.
They're in absolute disbelief once again. In all seriousness, yeah, the market continues to just chug along, chug higher, certainly on the stock side. Stocks just quietly moving up more over the past week or so. The Santa Claus rally's in full effect, apparently. People are getting more on board with the idea that the Fed is finally done and will be cutting rates in the spring of 2024. The inflation figures support that as well. We get more disinflation evidence from the inflation data this week. Unemployment still looks pretty solid. We've got unemployment that actually ticked down according to the official report in the US last week. So it looks like right now the market believes in the soft landing and the Fed has actually done it or that they're on the way to getting it done. So yeah, that's the market narrative, at least. We could actually discuss if that's true or not, but yeah, it's pretty good times to here towards the end of the year.
Absolutely. So taking a look at the daily dough, Trav, I know you wrote about the disinflation continuing, and we'll take a look at the charts here and see what rates are doing today. Actually, if we jump over to the 2-year and see, it's actually taking a nosedive. So stocks are bouncing. This is the NASDAQ. If we take a look here, it's just a little bit off of that all-time high from over a year ago. So yeah,
stocks are not bouncing. Stocks are ripping.
The NASDAQ is now up 50% year to date as of today's print.
Yeah.
You know, we always talk about like how the market likes to cause people the most pain. That can be true on the downside and the upside. And hopefully it's this mic that's working. Let me know how my audio sounds, guys, because last week wasn't working right.
Yeah, you sound good.
Okay, cool. But yeah, you know, the market can also cause pain on the upside and leave people behind and leave people going, wait, I thought the world was imploding. Robert Kiyosaki's out there saying that we're going to have another banking crisis like 08, and all the bears, all the memes on YouTube, the guys with the cover images, like everything's melting down. You know, what happened? And that's certainly what happened in Bitcoin so far this year. You know, if we take a look just at the yearly chart here on Bitcoin, it's up quite a bit, well over 150% and 156%. And that just totally caught everybody off guard because the low in the market was the FTX implosion a year ago. And here we are just trucking higher. So how do you guys see? I don't know. Does any of this make sense? Is it logical? Is it illogical? Is the market missing something, or is this just business as usual?
Have you guys not been listening to me be a broken record all year talking about how I thought the low was in October 22 and how I wouldn't be surprised if we have a choppy market environment or the market environment holds up and the labor market keeps it held up? I would hope people that have at least been listening to this podcast have heard some of those things so that they're not surprised and blindsided by this rally. I've been talking about for months and months since the beginning of the year, all year, about this. So I personally am not surprised. I've talked about how money markets paying higher interest, or just high yield savings accounts paying higher interest, people that have money, you know, obviously the rich get richer, and how a lot of boomers have a lot of spending power too. And the higher yields can almost act like a stimulus for a percentage of the population that has, you know, the right bank account. And people came into this year still better off on balance sheets than before, for many people. So I guess I'm not surprised. Now, do I think that the valuation in the S&P 500 is starting to get a bit overdone? Yeah. Yeah, there are still risks out there. We're still worried about, consumer debt. We're still worried about bankruptcies ticking back up. But all in all, I would say that the labor market being strong and inflation coming down, disinflation was my case for the stock market being able to hold up and for the consumer to be able to keep consuming, because that is a recipe for higher disposable income. If oil prices go lower, right? Gas prices are cheaper for people, cheaper to fill up the tank, more money in your pocket, right? And there are other baskets of goods that relates to food and other things. So yeah, I'm not surprised. I am glad that I was at least on the right side of it generally, and buying stocks the whole time too. But yeah, I think that we need to watch out going forward. This market could, another thing I mentioned is how we could see a pullback come from much higher levels. And that seems to be the scenario we might be looking at. We might be looking at, yeah, we're going to see that correction. We're going to see that pullback, but we're going to see it after we make an all-time high potentially in stocks, right? So people thought we were going to be making all-time lows, and here we are. That scenario is playing out. So people need to be aware of that. It's not that we're all bullish and everything's great and we're not going to see corrections. We will, especially as valuations stretch. It's just going to be probably from higher levels.
Well said. Yeah, I pulled up the Daily Doe back in August, where you talked about like the good and bad of high interest rates, and how, it was basically like a stimulus for savers. And yeah, it kind of feels like that, at least on the market sentiment side. It's almost like, I'm seeing echoes from the insanity that was 2021. Altcoins are back, meme stocks are coming back. Trav, what do you make of this? Is this logical? Is it a big trap? What's your I guess, prediction or thoughts for possible outcomes in Q1 of 2024?
Yeah, I think that the current environment is pretty logical overall, but I do think it gets harder from here. I think the theme for 2024 is it probably gets incrementally a little bit harder, particularly for certain areas of the market. The NASDAQ's up 50% year to date. It's going to be very hard for it to put in that kind of performance next year. Now, small caps, which have lagged, could have quite a bit of upside left if we do hit the soft landing, if the Fed does start cutting rates. And we are seeing the Russell index, for instance, popping up more today than the big indices. So that's something that could happen. So I definitely think, I've said this a few times over the past few weeks, but I think the playbook changes a little bit for 2024. I think we begin to worry a lot less about inflation and higher for longer and rates 5+%. And then it becomes more about, well, okay, now we've got a little bit more cushion with rates and inflation coming down, but what is the economy actually doing? And there are some signs out there that suggest that the economy is not the strongest or greatest ever. The Atlanta Fed's GDP Now figure, their preview for the fourth quarter GDP figures, has come down to like 1.5% or below, which is really kind of surprising given the strength in GDP we had last quarter with over 5% GDP growth. As we get into a more, disinflation type environment too, corporate earnings, it's going to be harder for those to grow at the same types of rates. So I think, right now strategists are saying that they do expect corporate earnings to grow at double-digit rates next year. I'm not sure we're going to hit that kind of figure, but if we do get positive earnings growth, that'll still be positive. But I do think it gets a little bit harder in certain areas next year. I was reviewing the 2023 strategists market calls though, and it's funny to look back at those because a lot of them were basically saying, be defensive, stay out of stocks. Stocks are going to have another bad year. And it was just exactly the opposite. So beware of consensus. Beware of consensus thinking. Beware of the Wall Street strategists forecast. They're often wrong. I'm actually going to do a video here pretty soon on my projections for 2024. So look out for that on Stock ETV.
Nice. Yeah. Talking about consensus, from the angle of Bitcoin, you even had guys like Jim Cramer, who I know never makes a bad call. He was on CNBC like early this year. I think it was in January or maybe December of last year, when Bitcoin was at its lows, saying, yeah, I'd probably sell here. Like, you should probably liquidate your Bitcoin holdings. Right. And that's why I love what we talk about, not just in the show, but also the wealth building community, about how to think like a contrarian, and when it makes sense to go against the herd. And then when it also at times can make sense to ride trends along with the herd. right? So there isn't like, there's a lot of contradictory like wisdoms out there in trading and investing, right? You'll hear something that sounds really smart that's like, oh, always bet against the herd, or, you know, the trend is your friend. It's like, well, which one of those is true? And they both can be true depending on where you are in the cycle or how things are aligning. So that's one thing that I love about the markets, is they're always changing, and what's true today or good wisdom today may or may not work tomorrow. So it's a constant process of evolution and hunting for that edge, and reevaluating, you know, market sentiment, technicals, fundamentals, right? And just always being on top of your game. And the people that didn't leave crypto and didn't leave the stock market in Q1, and when I was putting out watch lists and doing classes saying, guys, now is the time to plant seeds and prepare in the depths of bear markets, that's when, you know, that's where the money is really made, is if you do the work when nobody else wants to. And then when things are hot and moving, that's harvest season, if you're smart. And I actually tweeted today, I said, you know, this is kind of an unpopular opinion, but, you know, Bitcoin is a tool to massively improve the quality of your life, not just end up the richest dead guy with the most Satoshis. Said, you know, stacking sats is important, but it's okay to liquidate Bitcoin to do things like buy a house or pay off debt or move to a better location or fully fund your tax advantaged retirement accounts, which is something a lot of crypto people don't think about. Or just like any other major purchases that improve the quality of your life. But you know, there's this prevalent like hodl and never sell mentality in the crypto space that I think just misses the point of like what Bitcoin is really here to do. And that's to offer you this ability with these market cycles to plant seeds in the depths of bear markets and then harvest them during the bull markets to improve your day-to-day life, not to just have some ego and say, I've got more Bitcoin than you. Like, who gives a shit? How is your average day, right? Are you living your perfect average day? Or are you just like stacking, could be dollars, could be Bitcoin, could be stock portfolio, just to have bragging rights or something? But I don't know. That's my little soapbox for the day.
I want to go back to what you were talking about when we were talking about how no one kind of saw this coming in the contrarian mindset. The problem that I've watched this very closely over the past 12 months. I've watched everybody's opinions and, you know, taking it all in. Professional money managers to, you know, people on Twitter that probably don't really know what they're talking about, but I listen to them anyway just to see what's going on out there.
Yep.
And I think the thing people got wrong this year is they were so biased because that was consensus. They didn't change their opinion with the data. So many people, I mean, it was very easy by paying very close attention to the data to kind of let that guide you through this process, including paying attention to the price action in combination with the data. And people just didn't want to change their minds. They were just so set on, this is the bearish narrative. This is what's going to happen, recession 2023. And, you know, anyone from a professional money manager to a Twitter person was on this role here with this. So I just want to encourage people. That's why macro data is important to learn how to read. It's very helpful if you're managing your own portfolio, because it can kind of keep you from getting too caught up in all of that drama that we saw in 2023. And be open to changing your opinion with the data. Don't be so stubborn about it. I saw a lot of people get too stubborn.
I have to admit, you know, there was a period where I got pretty bearish this year, and that was right after the Silicon Valley Bank failure. We had entered the year actually getting long a bunch of stocks that looked oversold, and that did really well in January. But I was already trimming in January, February, and then Silicon Valley Bank hit, and I was like, oh shit, this is bad. This is very bad. And I thought that would, you know, be potentially a big negative catalyst for at least a few months. And what shocked me was how quickly it resolved without other secondary negative consequences, that at least that we could see. So that was a time frame, I think, between probably March and May where I got I definitely got bearish. Now I changed my tune pretty quick because, again, just looking at the data, like you said, I think helps to inform you there, and just not being, too dogmatic in your approach, not sticking too hard to either being a bull or bear, just really being flexible. And yeah, I mean, Chris, you mentioned earlier the difference between trend riding versus, calling a shift in the market. And, sometimes going with the herd actually is fine and great. And in fact, most of the time, trend riding probably works. But you do have to be careful of the blind spots when things do turn, and they can make a pretty abrupt turn. I think the bears, this is like the doomer bears, the perma bears. This is where they kind of get it wrong. They're always trying to call for that turn. And frankly, bearish turns in the market, particularly ones that we would say are like bear markets where you're 20% or lower, those just aren't that frequent, and crashes just aren't that frequent. So like, I don't know, they need to look at the base rate data on that. But yeah, so I think, it's really important, like you said, Nikki, to just be fluid in your opinions in financial markets, because there's so many variables and there's so many things constantly changing. But yeah, we're not always going to get it right all the time either.
Right.
Yeah. And, I'm thinking back to back in March when KRE, for you guys watching the video, you can see the regional banking ETF. Like when this was happening, in real time, yeah, this was like a scary thing, right? And a lot of people were worried that we were going to have an 08 GFC, and, things were looking very weird. And for me, I don't try to like predict what's going to happen. I just let price action really be the truth, right? It's like, I knew that for Bitcoin, at least, we actually shifted market direction the second week in January. That's not my opinion. That's based on very basic technical analysis. Like, that's what happened. And so I was like, all right, well, here's a panic induced like washout in price. It's a technical setup that I think is a high probability buy. So I bought there at 20K, and I almost like have learned to enjoy uncertainty, or like when the bears are celebrating and everybody's freaking out, like more times than not, that is a good buying opportunity. Now, obviously you need to learn to recognize when an asset is imploding, like the Luna Terra situation. It's like, no, you probably don't want to try to buy the dip on shit like that. But on quality assets, be it, a stock index, which is made up of the most profitable companies in the world, or Bitcoin, which is a scarce, high quality asset, things like that. It's like when there's a ton of fear in the market, if you can condition yourself to be there. And, Rocky, one of our buddies, has this saying, calling himself the buyer of last resort. It's like, if you take on that mentality, and I actually developed a strategy for TradingView that can help you find those opportunities where like being the buyer of last resort makes a lot of sense, which means when everybody thinks the game is over and everybody's panicking, when that fear subsides, oftentimes those are when you get the best reward for the risk that you're taking on. So that's why we hammer the mental game so much. It's like, if you get that part right, if you train yourself to have that ability to be disciplined and step in when everybody's freaking out, that's when you can make life-changing gains.
I feel like we've definitely talked about that a lot, and how when you have a market that is in a bear market, like we saw with stocks, we were down 20% in the S&P, more in the NASDAQ, Bitcoin, whatever you guys consider to be a bear market correction. I don't know what your number is, probably 50% or something like that. What do you
don't
guys
even get me
consider a
out of
bear
bed
market?
until we're below 50%.
Yeah, but we've talked about that. Like, when you see those kinds of drawdowns, that's when it's important to perk up and pay attention. And hopefully, this year, or the past 2 years, has been another lesson in that, really. It's like the more data we get, the more lessons we get. Yeah. And it helps it kind of get better ingrained in your brain.
Yeah. And that's why I actually build some of these strategies for trading views to help people like go back and actually look at the data and figure out like, oh, if I was disciplined and I did dollar cost average into Bitcoin when it's, 50% or more below all-time highs, what would the results look like if I did that for the last, 10, 20 years, 10 or, 5-year period or 3-year period, whatever you want to back test. But it just gives you the confidence to look at that and know what those results would be. And that just kind of removes the guessing, I think. So, no matter what your trading style or what it is, I just encourage people to always like try to back test and give yourself that confidence by really looking at the data and not just a bunch of messy opinions on social media. So,
yeah, well said.
All right, let's move on. So we talked about, the macro picture. Do you guys think, and I know you guys wrote about this in the Daily Doe, but it looks like, let me actually refresh. I'm just trying to think about, how fast are rates going to come down, and are we looking at drops in Q1, which is now, the market's kind of pricing in drops in
March.
mid 2024, March.
As
it's
of today,
ticking
as of today, we've now got a bigger probability that a cut comes in March.
Yeah.
Does that feel like a pipe dream to you, Trav, or does that feel like it could go down?
It is possible. It is in the realm of possibility, and I've been saying I think it could come as soon as March. I was actually saying this earlier in the week before the probability shifted. I was talking to one of our community members about it, and she said, "I think it'll be more like summer." And I said, "I think it actually could be as early as March," in which that might surprise people, but I think it could be as early as March. I do think that's a decent. I would probably put it my own odds at around 50 or 60%. It happens. The first one happens in March, and when it happens, it'll probably be a little baby 25 basis point cut. So it's not going to be that big of a deal. There's a shift, obviously, in the policy, but a very small actual decrease will probably happen in the first one. And the reason is, the Fed is going to be in a really tough position to be keeping rates at 5.25 if we've got CPI under 3, which is, again, a possibility as we move into the spring timeframe next year. One of the big drivers of that, well, I would say there's probably 2 big drivers right now. Energy prices, which continue to be very weak this month. And then on top of that, you have the shelter component, which we know is just now coming down because it's so lagged. It's like 18 months lagged. And we've talked about this over and over, but it's still printing like 5.5% increases in shelter. But if you look at actual rent prices today, if you look at the current rate of rental inflation, it's like flattish, pretty much. So I posted that chart in the Daily Doe, and I think that shows you that, that's going to continue to put downward pressure on the official inflation figures. We also got the PPI, which was quite low. So producers, the actual manufacturers of goods, are seeing, like, I think the PPI was down in the 1 or 2% range this past month. So that, that's the PCE chart. Actually, I think I put the wrong chart in our notes today, but the PPI numbers were in the 1 or 2% range. So how can the Fed justify, especially, they've got another meeting in January, and then they've got that March meeting, and then they've got that May meeting. January, you might be able to skip a cut. But by March, if you've had now a couple more readings of low inflation and they're still up at 5.25, how are they going to justify being so high still? And so that's why I think the market's coming around to the idea it could happen in March. Now, we do know the Fed is stubborn. They like to be slow. They like to be late to the party. So it is also possible we may not get cuts until May or even summer. But I think based on what we have in terms of data today, I definitely think March is a possibility.
Awesome. Yeah. One thing that we had this week is mortgage rates continue to fall and home builders continue to rip to new all-time highs. Just taking a look at the official numbers, we're down around 7%. So basically down from, 8% down to 7%. It's not a huge drop, but it is pretty significant when you look at, affordability. And Nikki, I know you did a video talking about, I'll try to pull this up, but you did a video this week talking about, like, should you wait or should you buy? So I want to hear your comments on if you still think that's the case or if something changes if rates keep dropping. But yeah, home builders just continue to rip to new all-time highs as rates drop. I think there's still a ton of demand for real estate. The problem obviously was affordability with these rates, but you know, if these rates keep coming down, I mean, what's to hold prices down?
Yeah, we'll probably get sub 7% mortgage rates here in the next couple days, which again, maybe 6.8 or 6.9, still not cheap
Right.
versus the last few years, but it's improvement.
And I
Yeah, I
think it
mean,
will give consumers that that confidence to be like, okay, you know what? I'm going to go ahead and like pull the trigger and hope that I can refi in the near future.
yeah, and if you compile that onto, builders giving incentives or buying down rates still, which I don't know how much of that is still going on, but yeah, it could definitely help move the needle on at least starting to get things moving again slightly. Any little bit helps when
Yeah.
people are looking and trying to buy a home. I mean, interest rates really make a big difference, and it could be, it doesn't have to be a huge move to really make an impact on someone's payment affordability.
Yeah. And in your video, I'm pulling this up. You guys can go and watch this, but you were comparing basically 3 different scenarios, like buy a house today at a lower price because prices have come down, but with a higher
Mhm.
interest rate versus buying later if prices go back up and rates fall. So you kind of
Mhm.
wait. So you lose that equity, but you get that, or buy now at a higher rate and then refinance in the future. And I guess like what were the conclusions that you came to based on this?
The conclusion that I came to is that in the grand scheme of things, especially since interest is front loaded on a mortgage, I think that the ideal scenario is obviously buy now, refinance, right? If you can afford the payment today, that's going to be the ideal scenario, assuming that, rates go down and prices go up, which nobody knows if that's even going to for sure happen and to what degree that could happen. But I think that the main takeaway is that everybody need interest if your interest rate doesn't go down in enough time, in a short enough time period, the interest that you have to pay on your loan, by being stuck in a higher, 7-8%, whatever the rate is, loan, if you have to continue to do that because rates aren't budging lower, then that could completely eat into equity and it kind of becomes a bit of a wash scenario. So the moral of the story is, yes, ideally, if you can buy at a lower price today with a higher rate and refinance, that's going to be a good scenario. But how long is it going to take for rates to get low enough for you to be able to get that refinance, and for it to make sense to where you're not continuing to have to pay that high interest in the beginning of that loan? So yeah, I'd say just watch the video. It kind of helps explain my thoughts a little bit better than probably what I'm doing now. But yeah, that's the idea.
No, yeah. At the end of the day, I think it just boils down to like, do you want to roll the dice and buy with lower prices and hope to refi in the future? I think if you find the right house and you can afford today's payment and you know you're going to be there for at least 5 or 10 years, I'd say go ahead and pull the trigger. If it's something where you're stretching and you really can't afford today's payment, yeah, you might want to wait. That way you don't get overextended or end up in a foreclosure situation. So,
Yeah, it's all about costs, and people forget about costs. Interest is a cost, refinancing costs money too. And
yeah.
so, I wanted to just point those costs out and show how it could end up not making, depending on which situation you're in, um you got to just go on what you can afford today, and the bonus of lower rates is ideal, but
Yeah.
we don't know.
All right. Do you guys want to have a fire round of Reddit conversations?
Yeah.
I've been diving in, man. Just the past few months, there's so many good questions on Reddit, and I'm usually let down by the answers. So I was like, let's just pull some of these for the show. So first question was for you guys. It's on the value investing subreddit. Person says, there's nothing cheap on the market right now. My coworker and I were just talking about this. We have some cash set aside that we want to put in the market, but we both agree that there's just nothing cheap in the market now. Compare today to the end of last year, where, yes, obviously we were in a drawdown and nobody wanted to buy.
Nobody wanted it.
Pretty much everything was down 40% in December. Does anybody else feel like this? Yeah, I mean, it makes sense, right? A lot of stocks and indices and sectors are close to or at all-time highs. Do you guys think there's anything of value out there, or are you waiting for dips, or do you see anything that's like, yeah, this is still kind of underappreciated?
There's still a lot of small caps, even in the US, that are still pretty cheap. And of course, globally as well, valuations are much better. But yeah, if you're looking at US large caps, particularly US large cap tech, there's not a ton of obvious bargains. I think there are some stocks that could continue to move higher, on things like margin improvement and cost efficiencies. I mean, things like, just today, Etsy, for instance, announced that they're cutting more headcount, which hopefully will improve their margins. And that stock trades for, I think, like 12 or 13 times cash flow. So I'm not saying that's the best company in the world or to go out and buy it, but there are examples like that where you still have things that are well below the market multiples. And in small cap land, you still have quite a few. And there's even, still certain sectors and things like Chinese stocks. I mean, that's an area that I've been kind of probing around because, similar to like last year, there was this consensus that Chinese stocks would rally because of the Chinese reopening. There was all those consensuses about how stocks generally in the US would be weak. Well, now the consensus is the opposite. Now the consensus is that US stocks are going to be surging and Chinese stocks are dead because of the Chinese property market. And China's, don't touch China. But I'm actually looking at the stocks and they're trading for single-digit earnings multiples. So if you can get comfortable enough and position size them right, i.e. not take too much risk because there's some geopolitical issues there. That's just a group of stocks that looks quite cheap relative to everything else. So there are pockets like that still in the market. You just have to know where to look. And, we're going to get pullbacks next year, I'm sure, as well. So you build your watch list, you build your buy list, and then you wait. That's one of the biggest challenges most investors have for markets, but that's what the greats do.
Trav, as you've been talking, guess what just happened?
Oh, what happened?
The NASDAQ just hit a new all-time high.
No
There we
way.
go. There we go.
Guys.
Oh, wow. It just tagged it.
There
Look
we
at
go.
that.
Lord.
There we go.
Wow.
Wow.
So,
I
yeah.
didn't tweet that, but that's, yeah.
Steaks
Wow.
back on the menu, boys.
Flying first class.
Now, can we talk about something very important right now? The wealth effect. Because now this is crazy to say, but with stocks at all-time highs or near all-time highs in the S&P, we're talking about people feeling wealthier again. And trust me, I know a lot of people personally that feel that, and they're very happy to see this. I wonder what that could end up doing. So stocks at all-time highs, real estate values not really cratering, equity not really cratering too bad for most people around the country, yields up still, people are getting interest on their savings. What does this look like, guys? Like, how do we think this could affect the economy going into 2024?
Well, here's an interesting reflation hedge. If you are worried about the prospect that the wealth effects can drive inflation back higher again, energy stocks are another group of stocks that are still very, very cheap. That's actually statistically the cheapest, like large sector within the S&P 500. You've got a bunch of energy companies trading for low single-digit multiples of earnings. Now, oil prices coming in, if they keep falling, that's going to be a problem for those companies' earnings. But as it stands today, based on current earnings results, like those stocks look really cheap. And if oil prices get pushed up because of reflation, that's an interesting sector. So there are starting to be some cheaper hedges now, even things like, put options. I mean, the VIX is hitting a new fresh 1-year low. So, you don't want to get too lulled to sleep here in the bull market. We got to be careful. We got to think about risk, maybe ways to hedge that are cheap. I think it's worth asking those questions for sure.
Well said. Yeah. I mean, what a wild end to the year, man. Bitcoin ripping, stocks new all-time highs. What else are you guys looking forward to? I guess the last 2 weeks of the year. Are there any bellwethers to watch out for, or any kind of risks on the horizon that could like surprise people as a black swan?
Ooh, that's a good question. The end of the year tends to be pretty quiet and pretty slow, and a lot of traders go home. So it can be a time where you do get some surprises, particularly in that last trading week, in that week leading up to, so after Christmas, but leading up to New Year's. what you'll often see is you'll see funky moves in individual stocks. So you'll see things like tax loss selling in certain stocks that are beaten up. So that can push things down, which will then pop in January. Or you could see people unloading. You could see, funny moves on low volume. So yeah, I think you should just have your watch list and watch that closely to see if there's anything funny that happens that you could take advantage of. Outside of that, major event risk, there's always the black swans, like I said, are black swans for a reason. You can't really predict them, but I don't know, there's still geopolitical events happening in the world, war, things like that. Could something happen in a time period where the US is lulled to sleep because of the holidays? That's always a risk. Energy is an area where there's always things that can happen, weather events or just other things that happen in energy markets can create pretty big moves pretty fast there. 2024 as a whole is going to be interesting because I think there's like 60 or 70% of the global population is going to have like a federal level election. So obviously we've got elections coming in the US at the presidential level, but also a number of other countries. So 2024 is going to be ripe with potential for change and for political risk. And that will have some ramifications for markets. So we'll start thinking about that some more.
Yeah, I think next year is going to be wildly volatile. Like some markets are going to rip, some are going to just, it's definitely going to be a fun year for us as like people active in the markets. So
real quick, what do you think Jay Powell's saying right now as he watches stocks rip? Do you think he's like looking at it like with his head in his hands, just like,
well, we know he likes to drop F-bombs.
Side note, continue.
Nice. Okay. Nick, here's a question for you. What are the best tax tips that you know of? This comes from the Fluent in Finance subreddit. There was a tweet that was going around. Nikki, I don't know if you saw this, but this guy said marriage wealth hack, long-term capital gains tax rate for a married filed jointly couples is 0% up to 80K of investment income. So basically a married couple who has a paid off house, quits their job, and now lives off of 4% of their $2 million taxable brokerage are paying $0 in taxes. A, is that true? B, is that as big of a hack as people think it is? And C, are there any other big tax tips or wealth hacks that people could be thinking about?
This is something I mentioned in our end of the year planning class for the Skill Incubator community. It is a hack. Most people can't take advantage of it because they have Social Security income or they have other income that kind of pushes them, because that $80,000 of long-term capital gains, it's all like it includes all income. So it can't be over 80,000, including your cap gains, Social Security, any other wages that you might earn, annuities that are taxable, anything like that. So it's all income has to be 80K or under. So that's something that not a lot of people can get away with. But if you have, a situation where you can live off not a lot of money, maybe your house is paid off and you can take smaller distributions from a taxable account and sell some assets for some long-term cap gains, then yeah, you can kind of maneuver that and give yourself some tax arbitrage there that is absolutely feasible. Problem is, a lot of people, they make over $80,000 of income, and a lot of those capital gains get bumped into the 15% bracket, but it's a hack.
Cool.
Other hacks, maybe for younger people that are still working, I think that maxing out retirement accounts, especially qualified plans that have asset protection attached to them, is a no-brainer. That is a above the line tax deduction for like a traditional 401k. And those are the best kinds of tax deductions that you can get. So I think that anybody saying 401ks are a scam, they probably don't understand how 401ks actually work and the asset protection and tax benefits that you can utilize. There's many others, but those are just, a few that you can definitely take advantage of. Tax loss harvesting, which is a big one going into the end of the year, something I'm personally doing, where I'm selling losers in my actively traded portfolio to net them against gains.
Wait, you have losing trades?
Absolutely. For sure. I have definitely made some mistakes coming out of 2021's boom. the boom and bust.
What's your biggest mistake?
I mean, I have a few of them, like CHPT, ChargePoint. I ended up selling that for a tax loss. There were a few other little ones that they weren't big positions, but they were positions that I probably just bought too soon and got too excited about too soon, coming off of all of the exuberance that was going around, especially with like electric vehicles at the time. But now, I'm looking at that in a different light a little bit. So just names like that they just weren't the best in terms of timing. Not everything, but definitely the ones that I just want to clean up my portfolio, selling those losers that I don't think are going to recover anytime soon, and netting them against gains. Huge, because the gains that I had are in a taxable account. So that is something that you can utilize to try to reduce your tax bill, especially if you have a high income year. That's even more important.
Cool. Okay. Next question. This is a fun one. Would you rather get paid $80,000 a year and not have to work, or $200,000 a year to work a high stress 9 to 5?
That's a good question.
I guess it depends on what your lifestyle is. Like if you live on a beach in Thailand and you don't have high expenses or expensive kids or anything like that, that could make sense. But that also can be really boring. And I think people have this idea of like just laying on the beach all day and not doing anything. And that becomes very unfulfilling really quick. So for me, I would take the 200K quote unquote high stress job, as long as it was something that was fulfilling and where I didn't hate the job. Sure, there could be stress that, like trading and investing and running a wealth building community, there's stress that comes along with that, but I'd rather do that than not. What about you guys?
I think it would heavily depend too on what my age was. If I'm 20, 21, 22, just out of college, I can do the high stress job for a while, so that would be a consideration, as well as like, if we're talking forever, I'd probably choose the opposite. If it was you've got to commit to this for 40 years, then I'd probably choose the lower stress one. But yeah, I think otherwise, like if you're young and hungry and like you said, like you don't hate the job itself, it's just high stress. Like, yeah, I mean, that's what I did for a decade in hedge funds. So that's definitely what I would choose if I was younger, and especially didn't have a whole lot of family obligations, things like that.
Well said. Nick, you?
I'm just going to say at this point in my life, I would probably go for the 80K to do nothing.
Okay. That's surprising.
I probably would. Yeah. But it depends on what stage of life you are.
I bet that would last all of 3 months and you'd go crazy and be like, okay, I need to get back into it.
I guess what I'm doing now, like I love it and I don't find it stressful. It's definitely busy and I feel fulfilled and I love my work. But if it was stressful, at this age, pushing 40 or whatever, I think that maybe I'd go for the low stress. Live out the rest of my days chilling.
I want to propose a middle path where it's like make a lot of money and work a job or a business that you love. Like,
but that's not the question.
I know. Well, I'm proposing another question or another solution.
Indeed.
This or that.
Awesome. All right. I know we have a bunch of listener questions and we'll get to a few of them. What are you guys hoping to get for Christmas?
A new iPhone.
Basic.
What, you mean a supercomputer that fits in your pocket?
Yeah.
That doesn't sound too basic.
A new iPhone, hint, hint.
I want a scuba diving trip somewhere.
Ooh,
I haven't been scuba diving in.
Oh, okay.
Am I scuba dive this year? I don't know. Trav, what do you want?
Man, it's always going to be pickleball related or athletic related. I need some new running shoes, some new pickleball gear. Just things around the health and fitness realm. That's definitely an area I just need to keep on top of in 2024, maybe even do a bit better than 2023. So yeah.
What's your favorite pickleball paddle right now?
Ooh, I'm looking at one of the new Yola paddles, the C2, the Ben John C2, and yeah, I'm looking at that one with wide eyes. So maybe Santa will put that under the tree.
Nice.
Okay.
Yeah.
Trav, another question for you. Any thoughts on the Southeast Asian markets? I don't know anything. I know the Thailand has a stock exchange, but I don't know anything about Southeast Asian markets. Do you?
I mean, not as much as I wish I did. We could call out a few, but the economic, if you zoom out, the economic growth in that region has been very, very strong. Generally, those stock markets have performed pretty well. But yeah, there's quite a few different countries you could call out there. Indonesia, you've got Thailand, you've got Malaysia, you've got the Philippines, you've got, theoretically, you could also add in more developed markets like Australia or New Zealand in there. And yeah, there's a lot to like there. That region, I think, will continue to grow over time. And the hard part, I think, in some of those stock markets, they don't always have the best stocks to choose from. Like in some of those markets, you've got a lot more industrial businesses that dominate those indexes and those markets. You can't always get direct access very easily as, like, say, a North American or European based investor. So that's another challenge. But generally, I'm pretty bullish on the Southeast Asian economy still. And, I think there's a lot of potential there, but you'd like to see, more options from an investing standpoint. There are some good ones out of Singapore, like the Singapore market's got a pretty good developed market. So yeah, I actually have invested in some companies on the Singapore exchanges in the past 10 or 15 years. And I really like those because they typically come with English filings, pretty good corporate governance. And you don't necessarily get that if you go to places like Thailand or even some of the smaller ones. So yeah, I wish I could give like more, on the ground level insights there, but I just haven't spent a lot of time focused on those markets in terms of actual stock picking lately.
There's a lot of niches to chase out there, man. So many countries, so many sectors, so many asset classes. Like,
Yeah.
it's a never ending game of learning in this business.
Truly.
One thing that has done really well is India. So here's India's Nifty 50, which if we look at the 10-year CAGR, it's, over 15%. And I mean, they've got what I think the fastest growing middle class, and they've still got some good demographics. And yeah,
India is like the new China in terms of, I think people are finally coming around to this idea. People have talked about this for a while. Like I think even Thomas Friedman, when he wrote "The World Is Flat" back in whatever early 2000s, was talking about India on the same level of China in terms of potential for economic growth and to become a huge economy. And it's gone through periods of boom and bust in the last 2 decades. But I think right now I've started to see India popping up in more issues of The Economist and popping up more in the Wall Street Journal. And you've seen the stock market do super well there. And yeah, I think it's probably going to become a bubble in the next couple of years because there are so many positive things happening there. And India is like, it's a market that I think people can get on board with more so than China because of the differences in governance right now. So yeah, I think India is a huge story that will continue to be a positive. Again, another market though, where it's really hard to get direct exposure as a North American based investor because that stock market has a lot of restrictions for investors that are based outside of India. So it's difficult.
Yeah. And even like the Nifty 50, which I think US investors can get easy access to, but the cost for the ETF is like pretty high.
Yep.
I think it's close to maybe 70 basis points, maybe more. I don't know.
Yeah, that's right. Yeah, they do. There are some small cap India ETFs we've called out for like the community when people have asked. Those also come with a little bit higher fees, but give you a little bit easier access to like a basket of small and medium sized companies, which I always think is interesting in growing economies like that.
Yep. Awesome. Another question we got was, will the Bitcoin ETF approval be a sell on the news event, or would flipping into ETH around that time make sense? That's a hard one. I mean, there's definitely a lot of buying in anticipation of a Bitcoin spot ETF. So it's hard to know. I mean, I think there would be some kind of capitulation or volatility around that. And then I'd have to let price action be a guide, because if there was like a pending approval and then it was like, boom, the approval happened and there was a big spike, I certainly wouldn't chase that going, oh, yay, retail's here, because it's not a thing where it's going to be like, oh, okay, the ETFs are approved and there's 100 billion overnight that's going to come in. Like, it's going to take several years, but it does open up the faucet. So I would just look to see how the market reacts. And I wouldn't look, I don't try to trade around major news events, period. It could be Fed announcements, it could be regulatory actions, it could be economic things. Like when I was day trading the stock indices, like we always just said, okay, there's a Fed announcement. We usually aren't even going to trade the day before, during, or after, the Fed announcements, because things just get weird. So I'm not going to try to predict what's going to happen. But there are certain things that I will not do, which is I won't front run it. I won't trade the day of the announcement. I'm certainly not going to just flip my BTC position into ETH for some kind of reason. Like, I'm just going to watch and do what I do most of the time, which is let price action be a guide and show me where there's a higher probability opportunity, where there's good risk to reward as well. So, yeah, look, I know we've been going for almost an hour. Any other things that you guys are looking forward to for the end of the year, or that you think people should be watching out for? There's several kind of looming black swans that are in Bitcoin that we've talked about for the past couple of months. I still think there's a lot of risk with Binance and, some of the unregulated exchanges. But are there anything else that people should be thinking about going into the end of the year that we haven't talked about already?
Got anything, Trev? I feel like we've got all this data now that it's like, okay, we kind of know what's happening. We know where things are heading. So it's like, we know inflation is tame. We know, or going down. It's still, and we know that the labor market is still chugging along. I guess the big thing for me, I want to see how the holiday season finishes up, because that I've been talking about this. I just think that that's a real gauge on the consumer, and what we can expect going into 2024, how student loan repayments has affected the consumer's ability to spend or not. So that's what I'll be looking at. I've been going to the mall and paying close attention and things like that. So it'll be interesting to see what that data actually looks like when earnings come.
How'd the mall look? And we do have retail sales coming out tomorrow in the US and China, by the way. So that'll be interesting. That'll be November numbers.
So I went to a mall that I grew up going to, and I've never seen it as packed as I did in a very, very, very long time.
Interesting.
So I was actually quite shocked. The line at Lululemon was insane. It was like past the little setup that they had it marked off to stand in the line, way past it towards probably the middle of the store. It was crazy. It was nuts. Ooh. So what I've noticed in a big city is that it is pretty booming out there in terms of a shopping season. So I don't know. We'll have to see if that translates to the actual retail numbers.
Yeah, I'm interested to watch too, just, price action wise, given what we're seeing today and the price action. And now that we have the Fed meeting and the inflation data behind us for December, I don't see anything that scares us before the end of the year, really, that could be like a big event. We've got a potential perhaps here for there to be another big blow off, maybe more meme stock trading. People get into a aggressive risk on environment, at least, for a couple of weeks. And so I think that could be very interesting to watch, potentially take advantage of with some opportunities, but also maybe even sell into that and actually use that as an opportunity to trim some areas of the portfolio that are up a lot this year, up a lot, at the end of the year specifically. So that's something I'll be watching very closely here in the next couple of weeks, is how that risk appetite evolves.
Nice. Yeah, I'm just focused on the price action. I mean, now that everybody's thinking all-time highs, and again, I want to be clear, like when we're looking at all-time highs, there's a couple of different ways to price it. If we look at the futures market, which obviously has contract rollovers and things like that, the NQ is tagging that all-time high. But when we look at the Qs or, an ETF, this is not quite there. So the ES is still playing catch up. It's got a few points to go, But yeah, I'm just really looking at price action around these all-time highs to see what happens. I think we could get some weird volatility. You know, an example of that is gold, where it tagged that all-time high, and then like it was weird because it was like Sunday night pre-market, it ran and then immediately pulled back. So just because we're around all-time highs doesn't mean that these indices have to run, but that's certainly something I'm going to be looking for, is like, is there a pop stop run where we just start to go parabolic through this? And then if that happens, how does that correlate with Bitcoin? My not prediction, but I think the highest probability scenario for Bitcoin is that we consolidate below this 48K zone before the end of the year. Because when I'm thinking about, you know, what the yearly candle looks like, we know that this 48 to 50K zone is major resistance from the last 2 yearly candles. So it would be, I think, lower probability for it to get through that in the next 2 weeks, but certainly anything's possible. I'm thinking and planning for maybe a run up here, consolidation, and then in Q1 of next year, maybe things just get hot right out of the gate. It's kind of how I'm planning it. But, you know, again, anything can happen, and I'm just going to let price action be a guide.
Yeah, this could end up being, in the indices, the biggest fake out breakout we've seen in a while. I mean, I wouldn't be surprised if that happened, because everyone's going to pile in FOMOing, right? Because they've been sitting out of the market, so they've missed out on all these returns. Markets break out, S&P and NASDAQ break out, and that's when people FOMO in more, and then boom, what do you get? You know, you get that pullback, and it's a fake out breakout. So that's possible. For sure.
Yep. Absolutely. All right. Well, guys, a lot we covered today. Hope you guys got value out of the episode. We enjoy doing these for you. And don't forget, go to wetalkmoney.com/community. Check out the wealth building community. Go to dailydoe.co. Get our newsletter every Monday, Wednesday, and Friday. And leave us a review. We appreciate you guys that have left us comments and stuff on Spotify and Apple Podcasts and everywhere else. Just make sure you're subbed to the YouTube channel, the audio podcast. We put a lot of time and effort into this, so we appreciate all the likes and shares that you guys do. And yeah, any final thoughts before we sign off here, guys?
Get us over that 2K mark on the YouTube subs.
Oh yeah, that'd be awesome.
We need that push.
Yes. Yeah, it's funny how, you know, a podcast YouTube channel grows so slow compared to like individual people, but hey, it's all good.
It's all good.
So awesome. All right, guys. Well, thanks for joining us, and we will see you next time.
Cheers.
See you later.